Investors are cautious today amid simmering fears that rapid hikes in consumer prices will lead to a deep economic slump. Wall Street banking giant Goldman Sachs issued a warning to its clients this week that it sees a 30% chance that the U.S. will slip into a recession. An economic contraction in the world's largest economy means fewer available jobs, a drop in property values, and lower incomes for households and businesses. All of that means consumers will have less money to bear the burden of rising inflation, fueled by higher oil prices. But there's optimism that Washington could find a way to provide some much-needed relief. The Biden administration says it wants to bring down the price of goods from China by slashing tariffs put in place by his predecessor, Donald Trump. Here's Treasury Secretary Janet Yellen talking about those plans earlier this week.
We all recognize that China engages in a range of unfair trade practices that it's important to address. But the tariffs we inherited, some serves no strategic purpose and raise costs to consumers. And so reconfiguring some of those tariffs so they make more sense and reduce unnecessary burdens is something that's under consideration.
Now, for more, let's go to Craig Erlam, Senior Market Analyst at OANDA in London. Welcome back to the program, Craig. Now, we just heard from Janet Yellen there, the U.S. Treasury Secretary, and one of the other things she's said in the past few days is that a recession is not inevitable in the U.S., that they can still avoid it. What do you say to that? Is there historical precedent for an economy facing high inflation, having to raise interest rates this aggressively, and being able to avoid a recession and keep the economy growing?
Well, I think the first thing to say is, as you've just alluded to, historic precedent isn't really on the US's side. We are seeing rapid rate hikes, and when we have seen that previously, a recession has tended to be the outcome. But as we always see in these situations, and I feel like we've said this a lot over the last 15 years or so, this situation is very different to what we've seen previously in many ways. The fact that we are coming on the back of a pandemic and the fact that the inflation we're seeing is being driven initially by supply side issues, then by an almost artificially tight labour market as a result of the pandemic, and a few other factors as well, it means that this situation is a little bit different. It also means that it may be harder for the central bank to get under control. But one thing that the economy has in its favour is the fact that consumers still have savings, which is something that's not necessarily consistent with what we've seen before. And also, debt levels are very different than what they've been before. Consumers are very much less sensitive to the issues in the housing market that we've seen before because of things like fixed rate mortgages. There's a lot of differences between the situation we have now and the one we had before, which may shelter households to some degree against these rising interest rates, and therefore make the economy less susceptible to a slump and a recession. But I still think there is going to be immense pressure, because when we're seeing 75 basis point rate hikes, when we're seeing 3% rates increases over the course of 12 months, then that is going to put the economy ultimately under pressure. And if we do see a recession, I just don't think it's going to be that significant as a result.
So it's going to be better, the U.S. economy in a much better place to weather this storm than where it was in 2008. And of course, during COVID, I mean, you couldn't really do a lot to control that, right? So it's going to be better for households. Is that what you're saying?
Yes, I think the composition of people's mortgage rates, the fact that it's fixed rather than floating, I think has a big impact, because it means that it takes longer for these higher rates to actually have a knock-on effect in terms of their monthly outgoings on that front. The fact that there is a bigger savings stockpile means that the consumers are going to be weather these higher costs a little bit better. Obviously, that's on an aggregate level. There are those worst off who are still going to feel immense pressure as a result of this. And I think debt loads as well are less than what we had back in 2008. So I think those factors are going to be supportive for households and for the economy. But like, as I said, as I've just alluded to, we can't ignore the fact that those worse off are going to feel the worst pain. And that's something that we need to be prepared for. And that's why government actions to try and support those in those positions are going to be so important to try and help avoid an economic slump and a recession.
All right, Craig Erlam at OANDA in London, thank you for helping explain that for us.
Thank you.